Smart investors know that the value of the United States dollar has declined. Our once strong currency continues to freefall, and for many it's not a question of if the dollar will collapse, but when. Right now, we're facing an economic uncertainty that will impact not only our currency, but currencies around the world. This event may be just around the corner, and it will send the United States into an economic maelstrom, most likely resulting in the demise of the U.S. dollar as the world's reserve currency. Before we get to the details of this impending catastrophe, it's important to understand the pathway that led us here. It's been said that you don't know where you're going until you know where you've been. So let's begin with a brief history of the U.S. dollar. At the end of World War II, delegates from all of the Allied nations met in Bretton Woods, New Hampshire, to negotiate and establish rules for financial relations among the world's major industrial powers. Known officially as the United Nations Monetary Conference, the delegates met for 22 days before signing an agreement on the final day. Bretton Woods established a number of new institutions like the International Monetary Fund and the International Bank for Reconstruction and Development. But it's perhaps best known for creating an international gold-backed monetary standard requiring each country to maintain the exchange rate by tying its currency to the U.S. dollar. This was seen as a safe tactic because of the strength of the U.S. economy and the U.S. dollar's convertibility to gold. That's right, it was gold that made these 44 nations feel safe and secure in this new monetary strategy. Under the gold standard, the United States could not simply print more money as they do today. Instead, every dollar was backed by the gold rate of $35 per ounce. The commitment of the U.S. government to convert dollars into gold at that price made this new agreement as good as gold. So why not just trade in gold? Because the dollar earned interest, and it was more flexible than gold. This was a match made in heaven, right up until the United States abandoned the gold standard in 1971. Why did we do that? Done in the name of stabilizing the economy and combating inflation, President Nixon implemented a series of economic measures in 1971 that effectively ended the Bretton Woods system. The Nixon shock was the death of the gold standard in America because it canceled the direct convertibility of the United States dollar to gold. In one swoop, our government had downgraded our once strong gold-backed currency to a weak fiat currency. In other words, our dollar was and still is backed by nothing more than the word of our government. No longer do we need more gold in reserve to print more money. Instead, the government can print money with just an empty promise. As you can imagine, this came as a shock to the global economy, and the demand for U.S. dollar decreased dramatically. That is, until 1973. In one of the most impressive feats in modern times, the United States struck a deal with Saudi Arabia in 1973 that would once again make the dollar the world's most desired currency. The United States offered weapons and military protection for Saudi oil fields from all of its neighboring nations, even including Israel. In exchange, Saudi Arabia agreed to conduct all their oil sales exclusively in U.S. dollars. This system, known today as the PetroDollar system, was a desperate effort to maintain global demand for U.S. dollars. By 1975, all of the OPEC nations had agreed to price their oil in U.S. dollars in exchange for weapons and military protection. And presto, the demand for U.S. dollars was once again alive and well. Today, almost all global oil transactions are conducted in U.S. dollars. To acquire those dollars, countries would have to borrow or trade for them on the currency exchange, a process that can be cost prohibitive. Therefore, many countries were forced to develop an export strategy with the United States that would enable them to exchange goods and services for the U.S. dollar they needed to purchase oil. Asian countries began exporting everything from cars and motorcycles to electronics, toys, and appliances. Is it any wonder that so many of the products that Americans purchase today are made in China or Taiwan? And while all these other nations have to work to earn their petrodollars to pay for their oil, we merely print them. Obviously, this couldn't go on forever. Today, it's no secret that many countries are taking steps to avoid the U.S. dollar and its status as the world's reserve currency. It's now hanging on a very thin thread. China and Japan, the world's second and third largest economies, are dumping the U.S. dollar, choosing instead to use their own currencies when trading with each other. However, this trend goes even further than bilateral trade. For years, no country has dared to violate the U.S. dollar pricing rule. But in November of 2000, France and a few other European Union members convinced Saddam Hussein to trade Iraq's oil for food, and even to sell Iraq oil in euros, not dollars. It wasn't long before other nations expressed interest in trading outside the petrodollar system to secure Iraq's oil. This movement threatened the U.S. dollar as the global reserve currency, and especially as the petrocurrency. Before long, the U.S. was invading Iraq, ostensibly over weapons of mass destruction. But was that the real reason, or was it because of threats to the dollar as the world's reserve currency? Given that the dollar was the petrocurrency, it should come as no surprise that the United States maintains a major military presence in the Persian Gulf. Today, several countries have moved away from the petrodollar system, including Russia, Indonesia, and those belonging to the axis of evil, such as Iran, Syria, Venezuela, and North Korea. In April 2002, Iranian OPEC representatives had delivered a detailed analysis of how OPEC might, at some point, sell its oil to the EU for euros, not dollars. Iran is reportedly China's third largest oil supplier, behind Saudi Arabia and Angola. In June, China imported around 524,000 barrels of oil a day from Iran, almost 40% more than in April. Two-way trade between China and Iran is estimated to exceed $50 billion by 2015. Iran's oil minister announced earlier this year that China will invest $20 billion in developing two of the country's top oil fields, and it's rumored that China may join Russia's Gazprom on the Iran-Pakistan project. But the biggest news is the Iran Mercantile Exchange, or IME. Established in 2006, the IME is a commodities exchange, not unlike the New York or Chicago Mercantile Exchange. It's just located in Tehran, Iran. The IME trades in agricultural, industrial, and even petrochemical products. In 2008, Iran's oil bourse opened and began trading. The exchange is currently regional, but there are plans to expand and become an international exchange soon. So what effect will this have on the U.S. dollar? International trade on the IME will be the death blow to the petrodollar system, and when the petrodollar fails, the U.S. dollar will crumble right behind it. It's simple because of supply and demand. When the demand for the dollar drops, so will its value. We've printed so much money in recent times that the only reason the dollar hasn't already collapsed has been the international demand of oil and the decades-old petrodollar arrangement. When the world no longer needs the dollar to buy oil, then what is the dollar good for? Who will be buying it? The short answer is no one. There's a major shift underway. One the U.S. mainstream media has left largely untouched. Global abandonment of the petrodollar, increased turmoil in the Persian Gulf, a banking system fraught with trillions in risk-laden derivatives, $16 trillion in government debt and counting. A byproduct of the falling dollar is inflation, which results in rising prices for the goods and services we all need. If you're concerned about the fall of the dollar or inflation, the most obvious solution is to invest in something that's increasing in value. Among traders and investors, the axiom is, the trend is your friend. The trend in the U.S. dollar index, which measures the value of the United States dollar relative to a basket of foreign currencies, is down and has been for years. As you can see in the chart, when the U.S. dollar index, in the black line, goes down, gold, designated by the green line, goes up in almost a mirror image. Are you confident your portfolio can handle the looming crash? Our monetary system is a house of cards based on paper debt. Isn't it time you start protecting your hard-earned money with gold? Let Scottsdale Bullion & Coin help build you a stable portfolio that will protect your assets from the disintegration of the dollar. Contact Scottsdale Bullion & Coin for a no-obligation consultation.